Trading options through earnings. How do you do it? Should you do it? What do you do? It depends. If you're investing, earnings are inevitable. You have to hold through them because that's part of the long-term game. If you're trading, you need to be aware. Do you want to trade through earnings or do you want to sit it out? It could be synonymous with gambling. Anything can happen. I've seen so many examples where the company beats earnings estimates, raises guidance, has a beautiful win across the board, and the stock sells off. Also seen the opposite, where the stock misses on earnings, but they guide higher or lower depending, and the stock surges. So anything can happen. What I have learned and what I would say is true is the implied volatility increase. It's really smart to sell options going into earnings. Keep a defined risk. I would never sell naked calls because that could really get ugly, and you can have an undefined risk characteristic where you can lose a lot more than you have. I've seen people lose their houses. I've heard horrible stories. So always keep it defined, keep the risk contained. Turn it into a spread. Selling puts, great strategy. Selling strangles or selling straddles, you got to be careful with that. I'd rather sell iron condors. I'd rather do a diagonal spread or a calendar spread, or something unbalanced, like buying an at-the-money call and selling, and say I bought 10 at-the-money calls and I sold 8 slightly higher short-term, like unbalanced stuff I do a lot of that. I think it's good to have a general thesis of direction, and then, and ideally, and sometimes this doesn't work, but sometimes you just have a little bit of a bias to the downside or the upside, and you just build a position where it's heavy positive theta. So you're going to get this huge premium decay. And after the earnings announcement, the premiums totally normalize and this positive theta is money in your pocket. But understand that there's ways to trade it and there's ways not to. Keep it defined risk.